The US economy seems to be firing on all cylinders. The jobless rate's down to near historic lows, growth's picking up, and inflation's risen nearer to the central bank's desired level. So by the time the Federal Reserve Chairman took the podium, most investors were already expecting an interest rate hike.
Today, we raised our target range for the short-term interest rates by another quarter of a percentage point.
But what Powell said after this caught many off guard and sent stock prices tumbling.
Many FOMC participants had expected that economic conditions would likely call for about 3 more rate increases in 2019. We have brought that down a bit and now think it is more likely that the economy will grow in a way that will call for 2 interest rate increases over the course of next year.
The Fed fears the economy may begin to slow down by 2019. It argues raising interest rates now would give it more room to bring them back down if a stimulus is needed. But critics including President Donald Trump and the Wall Street Journal say that's dampening investor spirits even in the good times.
I hope the people over at the Fed will read today's Wall Street Journal editorial before they make yet another mistake. Also, don't let the market become any more illiquid than it already is. Stop with the 50 Bs, feel the market, don't just go by the meaningless numbers.
The glooms quickly spread beyond US markets. Asian stocks were in negative territory on Thursday, even though Japan's central banks kept its benchmark rate below zero. And some analysts doubt the Fed will be able to raise interest rates more than once next year.
With regards to 2 rate hikes in 2019, I think they may even have to back off that, maybe to 1. And I think the real reason why is as the balance sheet continues to unwind, the balance sheet unwinds by Q3 next year will actually make up another rate hike.
But the stock sell-offs continued through Thursday, showing there are few investors who want to bet against the central bank. Mobin Nasir, TRT World.
Well, let's get more on this now from our editor-at-large, Craig Copetas, who joins us from Paris. Hi, Craig. The US Fed rate decision is really the ultimate guessing game for biz nerds like you and me and the team here at Money Talks. But tell us, how does the Fed go about setting interest rates?
You have to think of it as a painting. There are approximately 21,000 people who work at the Fed, and none of them, except for the governors and the chairman, are government employees. It's independent from the government. And what they do is they go out and they collect 3 ingredients: data, like growth, unemployment, housing, jobless claims. And then they gather anecdotal evidence. And again, think of this as they're putting together paint. They go door to door. They ask, like, how much you paying for groceries, that kind of stuff. Then they take those 2 items and they mix them together with their economic models. Now, these are scenarios, theoretical constructs that they put together with the data and the anecdotes. They get all that together and they paint a picture. And it's going to either come out as a realistic painting or, as a lot of people are today saying, really surrealistic and not good for the economy.
Okay, so why then do world leaders like US President Donald Trump and the Turkish President Recep Tayyip Erdogan even, why do they keep on campaigning for lower interest rates?
Well, the interesting thing about it is now not only President Erdogan and President Trump are campaigning for lower interest rates, it's even Wall Street. Wall Street is used to cheap money. Remember, just a few years ago, we were at near 0%. Now we're at 2.5. So when you have lower interest rates, it either removes or overshadows the perceived volatility in the market. Some say it keeps a bear market at bay. Now, nowadays, Wall Street, a lot of political leaders are saying, let's keep the cheap money in the system. It seems to be working. And they believe that this will continue to build a wall against recession or stagflation. So this is why a lot of people are very angry at the Federal Reserve today.
So we have the 4th US rate hike for the year. Jerome Powell's flagging a couple of others for 2019. Who are the winners and losers out of all this then?
Well, in cultural terms, millennials and Generation Z are the real losers. Those who are baby boomers win, at least theoretically. Look, it's going to cost young people more to borrow money, buy an iPhone, get tuition for college, maybe get a mortgage or buy a car. Now, it's also bad for emerging markets because with no growth and a potential recession, that means depressed prices for commodities, which principally come out of emerging markets. Now, this is great for old folks because they have money in the bank, and the higher the interest rate, the more of a return they're going to get on their investment. So that's kind of the situation right now. And what happens in 2019 when they're talking about 2 more interest rate hikes? Well, a lot of people are frightened about that right now.
Interesting. Okay, the baby boomers look like they'll come out on top once again. Craig Copetas in Paris, thanks again for your time.